Yeah. Interest rates are usually measured as a percentage per year, per annum. It's used to determine the return on savings and the repayment on loans. The bigger the amount of money that you're saving, the higher the interest rate on the loan and the more return on your savings. And the bigger the loan or the more risk associated with the loan, the higher the interest rate and the bigger the repayment you have to pay.
While all commercial and high street banks set their interest rates on risk and other factors, their rates are determined by what is known as the base rate. The base rate is set by the Bank of England, which is the UK central bank. The central bank is in control of the money supply. Every morning before trading, the banks must report to the Bank of England to take out a loan in order to trade. As a result, if the base rate is 3% on that loan the Bank of England gives, then the banks must trade at higher than 3% to make a profit. As a result, the base rate affects the rates indirectly in the market. Interest rates have a large effect on the macroeconomy. Economists can show this through the transition mechanism. First thing that we show on the transition mechanism is what the Bank of England is doing. In this case, it is lowering the base rate. Through lowering the base rate, this then lowers the commercial bank's base rate. A reduced base rate increases lending. And a reduced rate lowers repayments on mortgages because the mortgage repayment is based upon the bank's interest rates. So it lowers mortgage repayments. And finally, a lower base rate discourages saving. Increased lending, decreased mortgage repayments and decreased savings creates more money in the economy, which increases aggregate demand. And an increase in aggregate demand, as will be showed later, increases the economy. Also, a reduction in banks' base rate discourages foreign investors from investing in the UK. This then leads to the sale of UK pound. The sale of pounds means the pound's value falls, and as a result, this makes more exports, which again increases AD. Now if we analyse this, we can look at why this is such an effective tool in the UK. Firstly, we have a very high amount of lending in the UK, as we've seen on the credit crunch. Many people have credit cards, many people take out loans, many people have mortgages. This increased lending due to a low bank rate really affects the UK economy. Also, our economy is a home-owning economy. Many people have houses, and as a result, a reduction in mortgage repayments gives people a lot more money in their pockets.
What we got here is the long-run aggregate supply and demand curve. It shows the inflation one axis, and it shows the GDP growth on another axis. We've here got the Keynesian long-run aggregate supply curve, and we got the typical aggregate demand curve. If we say this is UK, in the newly done recession, the aggregate demand would have decreased due to numerous factors, which will be shown by a leftwards shift in the aggregate demand curve from 80 to 81. What the Bank of England did was it lowered its base rate to 0.5%. This, through the transmission mechanism, as explained by Jonathan earlier, will lead to an increase in aggregate demand, which will then shift the aggregate demand curve back out rightwards. Though it's unlikely to get it back to the original aggregate demand, it will help increase. It will help increase GDP growth, and as such, it will work towards getting the economy out of that recession. Disadvantages of the Bank of England using the base rate to affect the economy is that it doesn't go forever. For example, say that, the Bank of England lowered the base rate to 0.5% in the recession. But if it had come to further lowering to 0%, what else can you do? Because when it's at 0%, you can't go any lower. If you go below 0%, that would be equivalent to paying people to borrow your money. On top of that, if the Bank of England lowers the base rate, the high street banks are not obliged to actually lower their own interest rate. So say that the base rate is at 2%, is then lowered to 0.5% due to a recession and will increase aggregate demand. The high street banks might choose to, if the high street bank at 2% have got their own interest rate at 7%, even if the base rate is lowered to 0.5%, the high street banks could keep their interest rate at 7%, and as such, it wouldn't affect the economy in any way. In the recession we've just had, the lower base rate did not discourage savings, which could be associated with insecurity in jobs and stuff like that. So even though the transmission mechanism model suggested that it would encourage saving, in this case it didn't, though it did encourage spending, which has helped the economy to a, so far, recovery. That was it for now. That was interest rates. Next time we'll get something else.
Yeah.
Don't
That's all Danish and UK solutions. What on the board?
Yeah. Basically, I can't read it.
That's his writing.